Trade-based money laundering is one of the main ways criminals like traffickers, smugglers, and organised crime groups try to disguise and move the proceeds of their crimes. They also use trade-based money laundering to thwart sanctions, evade taxes and customs duties, avoid capital controls, or illegitimately claim tax incentives. The amounts these criminals can launder in this way are substantial, estimated to be at least many hundreds of billions of dollars each year. Unless action is taken, these figures are only going to increase. So why do these criminals use trade-based money laundering to move their ill-gotten gains? Well, firstly, as the financial system becomes a more hostile place for money launderers, trade is seen as an increasingly attractive option. Secondly, the scale, speed and complexity of global trade, which is valued in the trillions, also makes it difficult to spot illicit transactions. The criminals are able to hide their activity in plain sight amongst the millions of containers of goods transported each week. So what does trade-based money laundering look like? Well, most of it seems just like legitimate trading activity, and so it's very hard to detect. The most popular techniques used are mispricing, which is where trade goods are invoiced above or below fair market value, submitting more than one invoice for the same transaction, over or understating the volume of goods traded, using a false description for the goods altogether, or making up phantom shipments that don't even exist. With no set prices for goods, and with value varying based on quality, quantity, and other commercial considerations, detecting illicit trade is a real challenge. This challenge is largely shouldered by customs authorities, law enforcement agencies, and banks. Banks which provide trade finance products contribute to the fight against trade-based money laundering by implementing risk-based controls. These include a robust customer due diligence process to ensure banks know their customers and their expected business and transaction patterns, as well as checking against sanctions and other watch lists. Surveillance and other controls designed to identify and investigate potential red flags or key risk indicators, and training and awareness programs for employees involved in processing trade finance transactions. But there's a limit to what banks can do. Partly because they're not involved in every trade transaction. In fact, banks provide traditional financing in no more than 20% of cases. They have such limited information about the underlying trade deal in the other 80% of transactions, which are called open account transactions, that detecting trade-based money laundering is virtually impossible. And where banks are involved, they have no opportunity to physically inspect actual goods or containers. With the possible exception of the importer and exporter, no one party in any trade activity has a complete view of the transaction. Without the full picture, identifying and preventing illicit trade is incredibly difficult. Some banks think this risk is too great and choose instead to stop offering trade finance products altogether, which can have a negative effect on legitimate trade. So what are banks doing? Well, of course, they should apply the lessons learned from fighting cash-based money laundering to better understand illicit trade. Using automated surveillance, which is one of the key anti-money laundering controls for cash, may increase effectiveness to some extent. But this isn't enough on its own. In fact, momentum across the industry is moving in favour of a more tailored approach. For example, banks could use potential red flags to better identify and categorise higher-risk customers. They're also looking at ways to harness risk-based intelligence, bringing together comprehensive customer knowledge, transaction information, and other meaningful risk factors. With the added boost of innovative technology, this intelligence could be turned into a powerful weapon for experienced analysts to use against illicit trade. This may also help banks to react faster to emerging trends in trade-based money laundering. But clearly, this isn't a problem banks can solve on their own. The Wolfsburg Group, the International Chamber of Commerce, and the Bankers Association for Finance and Trade made a number of recommendations in their 2017 Trade Finance Principles. One of these is to have greater collaboration between the private and public sectors. Let's think about what this new way of working could look like if all stakeholders from shippers, airlines and truckers, ports and custom authorities, to businesses, banks and law enforcement agencies could find better ways of sharing information, then collectively they could do much more to disrupt these criminals. Just one example could involve each party contributing their limited information to a data pool to create a more complete picture. Customs authorities and law enforcement could then use this to find potentially suspicious transactions. Banks are ready to play their part and join forces with the public and private sectors in the fight against trade-based money laundering. Perhaps together we can turn the tide against illicit trade.